The markets have been breaking out this year as economic data takes the edge off the slowdown narrative. But as we head into what many are predicting to be a tumultuous new year, are the fears of recession truly in the rearview mirror? With us to discuss this, Daniel Morris, BNP Paribus Senior Investment Strategist, who joins us from London. And what is it? Are the fears of recession truly in the rearview mirror?
Well, there's always a new data point that could surprise us. But I think at this point, with the rebound that we've seen in the PMIs in the U.S. and also in Europe, again, generally speaking, we've had solid employment data, third quarter GDP. I mean, it's really hard at this point for us to see many data points that justify the fears of recession that we had just a couple months ago.
Well, it seems to me, Dan, that the exception to that, or the thing that could push that significantly, as you point out in your note to us, is if perhaps a trade deal doesn't happen, right? How do you trade on that, though? Because there is so much back and forth and such a drip of news. Do you just hedge against that possibility, however likely or not it may be?
Yeah, no, I agree with it changing from tweet to tweet, trying to trade it. We think it would be quite brave. I think what you want to try to do as an investor is to step back and think about what the implications are of the trade war more broadly for globalization. Are we swinging away from globalization back towards more nationalistic policies? What does that mean for where production is located, where sales are going to take place? So I think in terms of asset allocation, you want to look at it from that point of view, as opposed to trying to anticipate when or we might get a trade deal and what the terms are likely are going to be.
Hi, Dan. It's Dan Howley. As far as the yield curve inversion goes, everybody kind of had the sky is falling conversation, and now we're saying that there won't be a recession. But during those conversations, everybody had brought up the fact that it could take as long as 2 years for a recession to show up. So are we really just saying that this moment right now, we're not going to see any signs, and then later on down the line, about a year or two, we eventually will?
Well, exactly. That's what I guess is a bit convenient about using the yield curve as a predictor, is that at some point over the next 2 years, there's always some probability of a recession. And then you look back and say, oh, well, the yield curve inverted, so that told us it was going to happen. Certainly, we see by most indicators, the odds nonetheless have fallen that we'll see a recession in the next year. There's always the chance that we do get an external shock. But at this point, we really are looking for a soft landing, the fabled soft landing in the U.S. We think the Fed is going to be able to get U.S. growth down to trend, which is around 1.7. If that's the case, it does still give us a reasonably good cushion before getting anywhere close to zero, let alone negative. So for now, barring the unforeseen, we think U.S. growth looks pretty stable and pretty solid, even if not exciting. But for all that, it means it should be able to go on for longer than people had thought.
Jared Blickery here. The Chinese, especially the PBOC, has been adding liquidity to the system, lowering rates, but they did something interesting this week, which is they finally lowered the 5-year rate, which is tied to mortgages. And for all the talk about recessions here, I want to go in the opposite direction. Is it possible that the Chinese are going to inflate their property bubbles again? And do we have a risk of overshoot in that regard?
Well, property is one of the few areas where you are starting to see some positive signs in the Chinese economy. Even as we know, the third quarter numbers had the lowest quarterly growth since, I believe, 1992. The reason we're not really looking for a big acceleration in Chinese growth, one, of course, we still have the drag from tariffs that are very much meaningful for the Chinese economy. But I think the other reason is if you look at credit growth, that's also at quite low levels. And so without a bigger credit boost, it's hard to see the Chinese economy really taking off. So I think their objective, on one hand, is to continue to pursue the deleveraging in the economy. This is something that's been an objective for them for several years, so essentially clean up balance sheets for banks. At the same time, they want to rebalance the economy, of course, away from the dependence on exports and investments and towards consumption. But all of that means fundamentally lower growth, but hopefully with a better mix. So far, they seem to be sticking to that. And that would suggest we're not going to see a big reacceleration the way you had, say, in 2015 and 2016.
Daniel Morris is BNP Paribus Senior Investment Strategist. It was good to see you again, Daniel.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.